Thank you all for joining us here today for the Garden City Co-op annual meeting. Farming in the high plains of western Kansas is always a challenge, but this year we found it particularly challenging with some very confusing questions that we're trying to answer. First and foremost of those is the current devaluation of grain and where the grain price is, and the role that the lack of convergence of futures has played in that. And so we varied the program a little bit today, and the first part of the presentation will be focused on that. These are questions that are more complicated than your general manager or some of the other resources that we have locally can address. And so when we wanted to find you the best answer we could, we went to, of course, one of the leading agricultural land-grant institutions of Kansas State and offered an invitation to Dr. Art Barnaby. Dr. Barnaby has been with Kansas State since, I think, 1979 as a professor, and he has been a leading researcher and advocate of this current problem of basis and lack of convergence, both from a research end of things and as a consultant to the administrators and the legislators that may be able to play a role in that. We are very thankful that Dr. Barnaby opened up his schedule for us today. He was actually scheduled to be at a producer meeting in Ottawa, Kansas, and was so kind that he found some colleagues to cover that responsibility so he could be with you today and help us all understand what's going on. Dr. Barnaby received his PhD from Texas A&M and has been on staff at K-State since 1979, which will present an interesting situation for him in a couple of weeks at the Texas Bowl. But he assured me he is wearing purple today and he's a Bill Snyder fan, so we'll focus on lack of convergence and leave the football predictions for later. With that, please help me welcome Dr. Art Barnaby from Kansas State University.
Thank you. I was told to finish in 30 minutes, and that's what we're going to do. We're going to talk about non-convergence in the futures markets. It may be the first time you've seen it, and this is one of those subject matters where you might want to see it a second time. This work is underway, as was mentioned. I am with Kansas State University. I'm wearing purple. They write my check. I want to make sure that nobody confuses that I am with KU. I have nothing to do with KU. We all know about KU. They finally won a football game. You thought they'd won the national title. If you're a KU fan, I don't care. But they finally did win one. I am basketball. Well, in basketball, they got the best professionals money can buy. So, in fact, if they turn pro, they have to take a pay cut. So, in any case, let's get on this. Yeah, you guys are going to get me off topic. Let's talk about non-convergence. Actually, you see three topics here, and we're not going to get through all these today. Non-convergence, what it is, then about how can you address it, and then how it affects crop insurance and other government programs. You can go on Ag Manager, and I've created videotapes on each one of these topics. So if you didn't understand what I told you today, you get a chance to listen to me again. Basically, hopefully it's the same story. The simple definition is non-convergence occurs when futures and cash don't come to the same price during delivery period. In theory, if futures are at $4 at a delivery point, it should be $4. Now, Garden City is not a delivery point, but we do have delivery points in the state of Kansas, and there they are. At Hutchinson, Kansas, they should come together. Right now, Hutchinson, Kansas, those locations, they're not together, and we are in the delivery period for the December contract, so they should be coming together. Hutchinson, I think you'll find the cash price is probably $1 under. I haven't looked this morning. By the way, one other thing that might be worth something to you, the LDP today is 41 cents. 41 cents. This is the second shot that you've had at a 40-cent LDP payment. And that's quite a bit of money to leave on the table. Now, that is not a forecast, because if you take the 40 cents, sure as heck it'll go to 60 next week, and you'll say, Jesus, I shouldn't have listened to that idiot from K-State. So I'll just tell you up front, this is the second time we've been at 40 cents, and it is quite a bit of money. Anyway, non-convergence causes this wide basis, and it reduces the effectiveness of the short hedge. Since I got a real simple example of how a hedge works if you've not actually traded futures. But basically what you do is you sell futures, and let's just say you sold wheat at $5 on the board. There certainly were times when you could have done that. And at that point in time, the value of the crop is also $5, at least in theory. At harvest time, we buy back the position at $4, and we sell at the local elevator at $4. If everything works the way it's supposed to, we have $1 gain in our futures account, and we lost $1 on the cash side. The net is 0, and that's exactly how a hedge is supposed to work. Okay? Now, what's different this year is we sold at 5. We're going to buy it back at 4, and that's about where we're at. These numbers are pretty close to what the real numbers are. Problem is, we got to sell at the elevator at 3, and in fact, it's not 3 today. It's 2.55, I believe, is where we're at, as I was told earlier. So the point is that we didn't get convergence at Hutchison. Now, Hutchison should be at $3. That means out here we're about 35 cents under, 40 cents under Hutchison. Puts us right around 360, 355, and that's about where you're at today. Pretty close, okay? Lots went through that, but you had $1 gain in your futures account. You lost $2 over on the cash side, so you came up $1 short. That's true for both the farmer who hedges the crop as well as the elevator who hedges the crop. Same game, same game. The September hard red winter wheat contract non-convergence is about 70 to 80 cents under. If anything, it's probably widened since I built that slide. Again, we're not talking Garden City, we're talking Hutchison, Kansas. Hutchison, Kansas. You've got to add some more transportation to get to Garden City. We think probably the cash price is the real price, not the futures. And the reason we say that is all you have to do is drive across the state and see all the wheat and corn and grain sorghum and everything laying on the ground. In one case, I know one elevator was taking no corn or sorghum. They wouldn't even buy it. The reason was they're completely full of wheat. So with that much grain and no storage, yeah, the futures is probably not the right price. It probably is the cash. What this chart is showing you is the difference between at delivery points, not out here, this is at delivery points. Now, back here in 2010, notice we had the same thing. In other words, back in 2010, we were trading at about 85 cents under at Hutchison, Kansas, which means it'd even be wider out here, at 85 under. Now, normally, and this is just during the delivery period. So we're looking at just the 14 days during the delivery period. So the chart rolls over to the next delivery period, and we're now out here. This is September going off. We'll have to add on to this chart, which will be the December contract. As it comes off, we will add that to this line, and it'll come out here a little further. I think it actually is weakened a little bit, but I don't know that for a fact. In any case, this is what we expect to look like. At a delivery point, we would expect it to be in this plus or minus dime range. That's just noise. But that's where you'd expect it to be at. But again, that's during the delivery period at a delivery location. Delivery period at a location. And you notice it's gotten weaker. Now, anybody remember what wheat was back in 2008 or 2010? A lot higher, wasn't it? Much, much higher. So if you got an 85 under basis and you're trading $8 wheat, that isn't quite the same as an 85 under basis and you're trading $3 wheat, is it? So I converted all this into percentage terms. Percent lower or higher than the futures price. Again, cash versus futures. And in percentage terms, you can see it's now wider than it was back here in 2010. So it's actually worse in percentage terms, okay? We think the cash price is probably right. We don't think there's any big conspiracy out there. The real problem is you can't deliver on that contract. Probably when you first learned about futures and you went to one of our meetings, or if you graduated from K-State, the way it was explained to you is that you are going to sell wheat on the board, you're going to sell futures, and then at harvest time, you're going to buy that back or deliver 5,000 bushels to Hutchison. The problem with that is you can't deliver 5,000 bushels to Hutchison. Neither can the Garden City Co-op, by the way. You cannot deliver. There is nothing to arbitrage the contract. If there's no delivery, then what's going to drive futures and cash together? And if you don't have cash and futures coming together, you don't get this convergence and you don't get price discovery. So, I can summarize this to you in two quick points. Number one, you can't deliver. So don't go into a futures contract, particularly go in deep into the delivery period, thinking you've got an out. If all else fails, I can deliver. No, you can't. And if you get down to the end of that contract, say around the 12th or 13th of the month, where the liquidity is gone out of it, you may get caught in a long short squeeze where, yeah, you can get out, but at 50 over the market. Yeah, 50 over the market. You don't want to be there, is the point. And you need to know you don't have the option to deliver. Okay? The second point is, you probably think they're trading wheat on the board. They're not. What are they trading? They're trading a warehouse receipt. They're trading paper. And the reason I say that is because that paper has more value right now than does the underlying wheat. Right now, it's coming off the board at roughly $4. It actually is a little under $4, but coming off at roughly $4. Okay? You take delivery of that wheat in Hutchison, Kansas, and if I want to convert it to real wheat, that paper to real wheat, what am I going to convert it at? The cash price, roughly $3, and lose $1 per bushel. So the longs don't convert the paper to wheat. They leave it in storage, and they roll their storage hedge forward to December, to March, and they'll just keep rolling it forward as long as that price on the deferred contract is high enough to cover their interest and storage cost of holding the wheat. And until that wheat gets converted, until that paper gets converted into wheat, you don't get delivery. You don't get convergence. Until that paper gets converted to wheat, you're not going to get convergence. So that's where we're at. It's just sitting there, not moving. Okay? So, the other thing that's a little bit different too, in some places they're using a warehouse shipping certificate on the soft wheat contract, and that's a little bit different how that works. So, how do you fix it? Well, first of all, you got to understand, if you look back at that example where we went through the hedge, where's that dollar come from that went into the short account? That dollar came from the long. It's a zero-sum game. So, is you as a farmer or a co-op elevator who hedged your wheat, and you got $1 in your futures account, that dollar came out of the account of the long. And so they like the game just the way it is. So what you do is you confuse the issue with a lot of stuff that don't really matter. So the first thing you get hit with is low protein. Well, it's a lower protein than normal, but it only takes 10.5% protein to deliver on the wheat contract. 10.5. Doesn't have to be 13. And in fact, according to a USDA report, the western third of Kansas had an average protein of 12%. Now, the guys who are in the business might argue with the USDA report, but that's the only number I got. But nonetheless, I suspect that if you actually could deliver, there'd be plenty of wheat to deliver that would meet the 10.5 requirement. I think the big one there is limited storage. Low interest rates probably has some impact. These were the bids on that day, and again, why I'm showing you these locations is these are delivery points, and we're at 85 under. The first thing that usually comes up is people say, well, the way to fix this is expand who can deliver. Okay? The research says that's not going to solve the problem. Now, it takes a little bit to figure this one out, but what we're talking about is as long as it pays not to convert the paper to wheat, no matter how much you deliver, it just sits there. It doesn't move. And eventually, you're going to run out of physical storage. I don't care how big the elevators are. Eventually, it's going to just fill up. So it simply won't move the wheat until you create an incentive to convert it out of paper and into wheat. The next one usually comes up is let's just cash settle the contract. Well, the problem with cash settling the contract is you can't find anybody that agrees on the cash price. Now, I know you all know what the cash price is in Garden City, or there's somebody in the room that can tell you, but try doing that on a national scale that people will buy into. Any of you in the government program see this national average wheat price that determines your payments? K-State's estimate right now, you're shaking your head, yeah, $3.73. What idiot came up with that? You're looking at him. That is my forecast. As an idiot, I can also tell you, if you go back and track my history, I'm within 2 or 3 cents of the final number. So I am predicting what the USDA number is. How did the USDA number come up with it? Well, their official story is that they get a survey from all the elevators, and the elevators report 2 numbers, total bushels they purchased and the total dollars paid during the month. They sum those 2 numbers and divide them, and that's your national average price. I don't know if that's true or not. I don't have any insight to it. I do know wheat prices are higher in North Dakota and the Pacific Northwest, so maybe it's possible. The other thing, it's weighted, and we're now down to where the weights are smaller, so the prices, current cash prices, have less impact on it. Anyway, and this is what I'm talking about. These are cash prices for St. Louis, and this is wheat, and it's not hard red winter wheat. It could be any class of wheat. But you know something strange about those prices? They're all the same. You notice that? This is USDA data, and they're all the same. That didn't look right to us. In fact, I'm sure it's not right. So we went off and pulled off the daily reports. That came out of a database. We don't know whether it's an error in the program. We don't know if it's an error in the data that was entered. We don't know how USDA came up with this number. This is from the same USDA agency, and these are the daily cash prices that we pulled off one contract. And you can see these prices look far more reasonable, and they're very different than the ones you just looked at, which are cash prices for St. Louis. So trying to tie down exactly what the cash price is not an easy thing to do. Sounds easy, but it's not. A researcher at Illinois says just double the storage rate. Double the storage rate, and that will cause people to convert that paper into wheat. That would be a very abrupt move in the market. I'm not sure that's a good idea because you don't like surprises. Number 2, putting that in place means the CME would have to act. In other words, the CME would have to decide we're not having convergence, and therefore we need to greatly increase the storage costs. So you'd have to count on them acting. The longs are going to lobby CME not to act. So I really doubt that, while it's a good theory, I doubt that it actually be delivered on. Another theory, and this was actually considered by the Kansas City Board of Trade when they were still in business, they've since sold out to CME, is to deliver the wheat on a rail car. You would deliver a rail car full of wheat to Kansas City, and then at that point you're out of the deal. It belongs to the long. And it's up to the long to find out where to store the grain. They got to figure out what to do with it. The problem with that, 2 problems. The first one they came up with is that it's hard to get a single rail car. The second one is that this would really probably drive a lot of longs out of the market, and you don't really want to drive them out. Yeah, I know you all hate longs, and they're all screwing the market and those long hedge funds, but they're throwing a lot of cash in the market. And that provides liquidity, and it also at times, if we had a properly working futures market, provides pricing opportunities. So that got rejected. The other thing is, do you know how the board is paid? They're paid on commissions. So the more trading volume that goes on, the better it is for their bottom line. Farmers don't do a lot of trading. True farmer hedgers don't do a lot of trading. You sell a crop and you just basically hang with it until harvest time. You're not in and out every day, or these guys are in and out within the same day, generating a commission every time they roll a contract. If you're doing that, you're probably not hedging. The soft wheat contract had exactly the same issue back in 2008, only it got even worse. Rather than being $1 under, it was $2 and nearly $2.50 under the board. Cash was nearly $250 under the board at delivery points. Got so bad they had to do something. And so what they came up with is this variable storage rate. What this does is every month that it doesn't clear, the next contract gets an increase in the storage rate. And you keep increasing the storage rate till at some point the long taking delivery will in fact convert that paper into wheat. So that is the only contract that has it. Corn, soybeans do not have it. The only one that has this variable storage rate is the Chicago soft wheat contract. This is the one we just looked at. This is the Kansas City chart that shows how much that cash is under the board, and this is the Chicago contract. And for the current period, notice that back when the September came off the board, we actually had cash above the futures contract when it came off the board. So at least at this point, when you look here, and here's where it was really bad, why they put this variable storage rate in. But since then, it's pretty much behaved the way it's supposed to. Pretty much behaved the way it's supposed to. This is research work done at Illinois, and you notice this little blip right here? What that was is initially Chicago tried to do the same thing Kansas City did. Kansas City, when they got this problem, because they had this same problem back in 2010, what their fix was, they didn't do the variable storage rate. What Kansas City did was put in what was called seasonal storage. And for the first 6 months of the marketing year, they increased the storage rate to roughly 9 cents a month, okay? And then in December 1st, it drops back to 6 cents a month, which is really going the wrong way. Doesn't help you. They also thought they would get by with just doing a seasonal storage rate, and that was this little blip here. So when they went to the variable storage rate, all of a sudden, this is at least the researchers' estimate of what the real value of that storage was. And we got storage, the value of the storage is more than what they're getting, or we're getting out of the market. So at this point, this is the solid line is the actual numbers. This is their estimate. And you notice that the market's actually anticipating where it's going to end up. So that bump in the storage rate is what convinced those longs to get out and convert to paper, or convert the paper to cash. Now, what do I expect to happen? What I expect to happen is the status quo. It's going to be very difficult to get anything changed here. If it happens, I can tell you how it'll happen. It's going to happen by somebody in this room. You folks are the ones who would have to talk to your congressman, your senator, and say, this is unacceptable, this market failure. It drives a whole lot of stuff that we're not going to have time to talk about today, but nonetheless, it's there. One thing I would like to raise is we're trying to get some people that will go on tape who actually tried to deliver on their futures contract and discovered you can't deliver on a futures contract. If there's anyone in this room that's actually tried to deliver, please call me. I'd like to hear your story because that's the best way to get this out. But nonetheless, it's going to be difficult to get this to change. Now, the other thing is maybe it makes sense to just hedge with the soft wheat contract and forget this hard red winter wheat contract. We're not ready to make a recommendation on that yet. We haven't run enough numbers to really know. But there are times when it did do better. The thing about it is it is a it's a shipping certificate it's delivered rather than a warehouse receipt. The thing about a warehouse receipt is that the bushels have to actually be in storage in Hutchinson, Kansas. With a shipping certificate for St. Louis, for example, you don't actually have to have the bushels at the shipping point. They could be in North Dakota. They don't have to be at the shipping point. The person who's going to load out that barge, and it goes out on water, has to have the expectation of being able to get those bushels in, quote, timely manner. Because the person who took possession of that long position gets to determine when they load out the barge. And so when they say load the barge out, they have to be able to load it out in a certain length of time. Now, there's all kinds of exceptions for dock strikes, weather, I don't know, several other things that can come into play. So it's not absolute. It puts you more in an international market, and given that wheat goes out of the country, I've actually wondered if we wouldn't be better off with a shipping certificate than a hard red winter wheat receipt. The problem is, where do you go to get water in the Great Plains? Closest one I know about would be St. Louis. Kansas City can load out barges, and Tulsa, there's a port there to load out. But you wouldn't be loading out at Hutchinson, okay? All right, how are you going to manage in this environment where we don't get convergence? And the only way I know of is more on-farm storage, and that's exactly what I expect to happen, is more farmers will put up their own storage. And if you go outside the state of Kansas, up in the northern plains, farmers up there have a lot more on-farm storage than what is typical down here. But nonetheless, that means you're hanging on to it for a longer period of time. We've talked about that. The only one with a variable storage rate. And the delivery of that shipping certificate is all classes of wheat. As a matter of fact, in July, there was a train load of wheat that was actually delivered on the soft contract in St. Louis. And the train came out of central Kansas. So rather than deliver wheat to Kansas City or to Hutchinson, they actually delivered the wheat to St. Louis. As I said, you can deliver any class of wheat. It doesn't have to be hard red winter wheat when you're going to that market. That should tell you something. Why are you shipping train load of wheat to St. Louis if there's not something screwy going on? As I said, we put all this on videotape and posted on Ag Manager. That is our site. We just updated this, and we, by K-State standards, we spent a ton of money building this website. We just redid it. And the Garden City Co-op was generous to us and made us a contribution to the website, and we thank them for that. To get on the website, anyone can get on the website. It's free. If you'd like to get on our mailing list, just send us an email or catch me in the back of the room and give me an email address, and we'd gladly add you to it. There is no cost to you, and you would get a note every time it's been updated. So I encourage you to take advantage of that, and there is my contact information, etc. If I could just summarize real quick, key points here: farmers can't deliver. If you didn't get anything else, understand that. That is not an option. Not an option, okay? Not an option. And because we're not getting arbitrage at delivery points, meaning not enough wheat's getting delivered, is the reason we're not getting cash and futures coming together, okay? Not happening. I had another point, but I don't know what it was now. Oh, well. Now I can deliver. Can deliver. Don't go past that one. Can deliver, okay? Do we have time to take a question, or what do we want to do? Because we're right on pretty close to the 30-minute number, I think.
We would encourage you to ask a question now. Dr. Barnaby has to return to Manhattan, so he won't be able to be here for our regular question and answer period. But if you have a question, please raise your hand. I'll get the mic to you.
Must have done a great job teaching because they all understand it, yeah.
Is that how the students act as well, Doctor?
Yeah, well, usually most of them are asleep.
Do you have any questions for Dr. Barnaby?
What's the tax man going to say about hedging a different crop than what you're supposed to be hedging? It's not a hedge in, is it?
IRS won't understand any of this. They'll think it's wheat. I wouldn't worry about it. That would be the least of my worries. They're going to think it's wheat. My only point in making it clear that you're trading a certificate is to explain why this certificate has more value. And the reason it has more value is because if you take delivery of that warehouse receipt and you convert it to real wheat, you're going to pay $4 for it, and you're going to turn around and sell it for $3 and lose $1 on every bushel. Okay, and until we get that wheat moving, in other words, where it doesn't pay to store it, we're not going to get this convergence. We think this is going to probably last for a couple of years based off what's happened in the past. I did talk to the National Wheat Growers. They were all excited about doing something. I've been down this road before too. What happens is in 2 years we get convergence because of some issue, probably a production problem somewhere in the world, and there's a new problem with wheat, and so they forget all about this. And then 3 or 4 years later it shows up again, where we don't have convergence. If you don't have convergence, you really don't have price discovery.
When did we lose the ability to deliver, or did we ever have it?
As far as I know, you never did have it, okay? Now, I know there's a lot of farmers out there that think they have it, and there's a lot of professors that think they have it. How do I know we didn't have it? Because I got a call from my broker and said, Art, can't get you out of the market. I said, what do you mean you can't get it? Well, I can get you out at 40 over. I said, well, the hell with them, let's just deliver on them. And that's when I found out you can't deliver. That was a couple of years ago. So I learned it the hard way too. We are doing everything we can to make it clear that this is how this game works, that you can't deliver, and that does change how you're going to market the crop if you're using the board to hedge with. And I think that's very important. I think it's also important that people who teach this stuff understand what they're teaching and teach it correctly. And we're trying to get on the program at a national meeting for other professors to explain just exactly what I told you. That hopefully happens because I think it's very important that when it's taught that we simply tell folks delivery is not an option. You're going to have to buy back the position when you get out. And I know it's not taught that way. I didn't learn it that way either, okay? If it makes you feel better. But still a lot of the country is still teaching it the other way. We can't make the hedge thing work. If you're going to make the hedge thing or the convergence work, K-State can't fix that problem. But what we can do is do everything possible to educate folks about delivery, about what's being traded, and that will be useful in and of itself. Even if we don't get it fixed, at least you know where the risks are if we do the teaching correctly. K-State can do something about that, and I promise you we will. What we can't do is fix the convergence. I think probably the mechanism's there to fix it. The Commodity Futures Trading Commission, all they have to do is act. They've got a market failure. They should be coming forward to move those two markets together. And there's no indication the CFTC is going to act unless they get pressure probably from Congress.
Dr. Barnaby, I would like to address your question, Tom, and that is, nothing changed in the futures contract. So farmers never did have that. So why did we not have a problem until 2010? And why do we have one now reoccurring every time we get large crops? Now, research may not bear me out, but I've got an opinion about that, and I think that it has to do with the fact that prior to 2003, when farmland went broke, we had a cooperative presence in delivery elevators. And so there was a discipline in the market that happened that is not happening today. When we lost those delivery elevators from the cooperative system, we lost something tremendously valuable. And unfortunately, we've learned that lesson the hard way, but we need to remember it. Take care of your cooperatives, because that, Coke, nitrogen, a variety of things are examples of what happens when you lose the discipline of a cooperative in a market.
Thank you.